Rail and port operator Asciano has tripled its annual losses to nearly $1 billion. Profits were up and earnings came in on target at $724 million, but a hefty write-down of $1.1 billion wiped it all that out. Earlier I spoke to Asciano's CEO, Mark Rosethorn. Mark Rosethorn, thanks for joining Lateline Business.
Thank you.
Your earnings forecast has been well received, but you still have a big debt pile that you have to get through. How are you going to do this?
Okay, we've got a well-considered debt strategy over the medium term. Our immediate thing, obviously, is to deal with our maturity in 2012, May 2012, which is $2.25 billion. It's our intention, and we're well planned to do this, to embark on a non-bank refinancing of that. So we've got plenty of time, the plans are in place, and we'll execute over the next 12 to 18 months.
You're relying on Queensland as a key growth area for the business. Whereabouts in the state do you see that growth?
It's primarily around the coal regions in central and northern Queensland. We're hopeful of attracting some new business into the system in the North and Newland system, but also equally in the Blackwater and Goonyella systems.
But there are problems in Queensland. Now, while you have been eating into Queensland Rail's market share, there is another player wanting some of that, and that's under the Queensland Coal Consortium bid. If that bid is successful, where will your business in that state come from?
Well, there's a difference here. The below rail assets of the business, the coal miners have put a bid into the Queensland government. We understand they're in due diligence now. The above rail operations are quite distinct from that. So we compete against QR, Queensland Rail. We've been successful, as you say, taking to date 45 million tonnes of coal from them. That's anticipated to be in 2012. So we've just done 14 million tonnes. We'll do 30 this year and move it to 45 in F12. And we expect that growth to continue.
Moving to Victoria. Now, at the moment there are some big factors at play. The Victorian government is reviewing capacity, particularly at the Port of Melbourne. If another player enters the market there, Asciano will be greatly affected. What plans do you have in place if this happens, given you have the lease there until 2017?
Yeah, at the moment the Port of Melbourne is conducting market soundings around capacity and competition issues. We've met with the Victorian government continually over the last 12 months, and we will embark on, obviously, respond to that document. We think there's a better plan and a better alternative, which we'll roll out over the next couple of weeks.
But realistically, there's pressure on the Victorian government to expand the ports and get transport off the roads.
That's true, but equally, if you look at the port's plans going, say, to 2035, Victoria has to cater for 8 million containers going forward. So at the moment it's 2. What they're looking for in this process is certainty around the next million containers. But we think we should look at this in terms of a long-term plan, and to do 8 million containers, it will cap the opportunity with East Webb Dock, which is being contemplated by the Port of Melbourne. And so the other areas, July and Hastings, they need to be considered in this.
But you must be concerned that if it goes through, it may eat into your profits, given the container ports business is such a large money earner for you.
Oh, it's a crucial part of our business, the container ports. What we've done in terms of our long-term planning, we've assumed that a third operator will enter in Melbourne. Let's assume it's Hutchison, who have been successful in Sydney and Brisbane. If we look at, say, the worst case of them entering the market in financial year 2015, we see our volumes being plateaued for about 30 months. So, yes, it does have a financial impact. It is into the medium term. And we're still obviously wanting to resist a development at East Webb Dock because it cuts into our current customers. So we'll be defending our customers' interests in business going forward.
If those volumes plateau for 30 months, how comfortable are you about being able to pay off that big pile of debt?
No, it doesn't have a material impact on on the debt. The debt at the moment, as I said, the 2.25 will be dealt with over the next 18 months. And then we've got, and we have currently got, adequate liquidity in our business, and the leverage levels for a business of our type and the cash flows we generate is adequate and satisfactory for the business that we've got.
Mark Rosethorn, we'll leave it there, but thanks for joining Late Line Business.
Thanks, Bridget.